How do you actually pay your taxes in retirement? Great question. In this video, we're going to walk through your two options and when you should consider one versus the other. I'm Jack. I'm the owner of JRO Wealth Management, and I help people manage their income, taxes, and investments throughout retirement. Let's talk taxes. When you're working, paying your taxes was a little bit more straightforward because every single time you get a paycheck, your employer withheld taxes from it and sent that off to the government for you. But now you're retired, so it's your job to figure out how you're going to do that. And you have to remember that taxes are a pay-as-you-go system. All that means, as you earn income throughout the year, you need to pay taxes on it. If you don't pay enough taxes throughout the year when you're filing in April, you could get hit with a penalty, which means you're going to owe more money on top of what you already owe. And we want to avoid that. So you have two options: withholding and quarterly estimated tax payments. You could do one or both. You can mix and match depending on your situation. Given the choice between two of them, I prefer withholding. I think it's easier set up. You can make changes later if you want. When money hits your bank account, you don't need to set aside any for any future estimated tax payments. And I'll share a story in a moment. If you need to play catch up later in the year, it's pretty easy to do so. But let's walk through both options to see when one makes sense versus the other. Withholding. It's just like when you're working, except you control when and how much. If most of your income is from these sources, withholding is available for you and you can do it online. So, for example, your IRA. You log into your custodian site, show Schwab or Fidelity, wherever it's being held, and you say, hey, every single time I take money out of this account, withhold X% for federal and X% for state. Social Security is a little bit unique in which you can only set up federal withholding and you can't tell them the percentage to withhold. They give you a few options and you need to pick one of those. So it's not as flexible as the other options, but you can still set up federal withholding if needed. You set it up one time, and then every single time the money hits your bank account, you know that taxes are being withheld for you. Now, maybe you're in the position in which you're already receiving that kind of income, but the withholding isn't enough. Here comes the story into play. I helped someone recently, and we're looking at their income, the cash flow, and they're receiving pension and money out of their IRA. And they said the withholding was taken care of. That was the default minimum withholding. So while taxes were being withheld, it wasn't going to be enough to cover their liability when we filed in April. And it was actually so little that was being withheld, they're going to get hit with a tax for not having paid enough throughout the year. Or excuse me, they're going to get hit with a penalty for not having paid enough throughout the year. So all we did in the fall, we just updated the last handful of distributions. We increased the withholding so that we could pay enough taxes throughout the year, because remember, taxes are a pay-as-you-go system, so they're not getting hit with a penalty when we file in April, saving them a little bit of money. That's the advantage of withholding. If you need to play catch-up later in the year, you can easily do so. So why would you do estimated taxes then? Maybe withholding just isn't an option for you. If you're retired early 60s and you haven't started Social Security and you're not taking money out of your IRA or 401k, there might be no income for you doing withholding on. If most of your income is from these sources, you should look at the estimated tax payments route. Here are the quarterly estimated tax payment due dates for federal. Couple notes on these. The dates are a little weird. Quarter one actually lines up with when you're filing your tax return and making that payment, so you might have two payments due at the same time. And then quarter two is actually only 2 months after quarter one. The other note, if you're making state estimated tax payments, make sure you know what that schedule is, because not all states line up with these. For example, California, the dates line up with federal, but you actually only need to make 3 payments because the September payment, the amount owed, is 0%. So just verify whatever your state is. If your income is pretty steady and stable throughout the year, you can probably get away with just making even payments every single quarter. If it's not steady though, maybe you sold a rental property, maybe you sold your home and you owe taxes on it. Maybe you did a large Roth conversion and you actually didn't withhold any taxes on that. You might have to adjust a payment for that quarter in which you earned the income. But if you're in that boat though, you should probably link up with a professional just to make sure that you have your bases covered. Here's how I help people make estimated tax payments online for federal. You go to this website, you select estimated tax as your payment type, and then I recommend the bank option. It's free, it's no processing fee, it's the most straightforward in my opinion. When you make the payment though, make sure that you save the payment confirmation page for your records. This way you have proof that, hey, I did actually make the estimated tax payment. These are your two options to pay: withholding and quarterly estimated tax payments. You can do one or both, whatever works for your situation. But regardless of which you pick, check in later in the year to be sure that you're on track to cover your liability. Now, we know the two options to pay your taxes. The next question is, okay, well, how much should I pay? And I'll cover those in future educational videos and case studies. So if you want to see those, go ahead and subscribe. Take it easy.